Well, I've been thinking a lot about retirement lately. Not my own retirement. I'm 70 and I have no plans to retire. I've said before that the idea of full retirement sounds awful to me, and I hope to keep working for another 20 or 30 years if my health allows it. But retirement in general, how people prepare for it, how they fund it, what they do right and what they do wrong. And I've noticed something troubling. Most people approach retirement completely backwards. They work for 40 years, save some money, and then hope it's enough. They don't have a plan. They don't have the right assets. They just hope. But hope isn't a strategy. And when you're 65 years old and realize you don't have enough money to stop working, it's too late to fix it. You've run out of time. You've run out of compounding years. You're stuck, especially now as we head into 2026, with the economic outlook showing sturdy global growth around 2.8%, but also uncertainties like potential tariffs, inflation pressures, and shifting markets. The US might outperform, but that doesn't mean everyone's portfolio will. That's why today I want to talk about the 5 assets you must buy before you retire. Not should buy, must buy. These aren't optional. If you want a secure, comfortable retirement, you need these 5 assets in your portfolio. And with 2026 bringing opportunities in resilient economies and strong corporate earnings, this strategy is more timely than ever. It's about positioning yourself to benefit from continued equity gains, even if they're tempered by higher borrowing costs or policy changes. And I'm not going to talk about fancy hedge funds or complicated strategies. These are simple, proven assets that have worked for decades. Assets that generate income, assets that protect against inflation, assets that let you retire with confidence instead of fear. I've built my wealth through smart, long-term investing, from starting Microsoft in my 20 seconds to managing the Bill and Melinda Gates Foundation Trust today. And I've seen how these kinds of assets can compound over time. I've always said, save like a pessimist, but invest like an optimist. That means preparing for the worst while betting on the future's potential. And in 2026, with predictions of positive returns for bonds and emerging market opportunities, optimism in your investments can pay off big if you're diversified properly. I've learned this from decades of experience, starting with dropping out of Harvard to pursue software, which was a risky bet at the time, but one that paid off because I believed in the long-term potential of technology. Now, as I focus more on global health, climate change, and education through my foundation, I apply the same principles. Invest in what you understand and what can make a lasting impact. So let's start with the first and most important asset you need before retirement: a diversified portfolio of dividend-paying stocks from companies with long histories of increasing their dividends. This is the foundation of retirement income, not bonds, not annuities, dividend-paying stocks. When you retire, you need income. You're not working anymore, so you need your investments to pay you. You can sell shares and slowly deplete your principal, or you can collect dividends without selling anything. If you're selling shares to fund retirement, you're on a countdown. Eventually you run out, but dividends can continue forever. You own the shares, the companies pay you quarterly, and if you own companies that increase their dividends every year, your income grows over time. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, McDonald's are solid, but in my portfolio through the Gates Foundation Trust, I hold Waste Management, Canadian National Railway, Deere & Company, and Caterpillar, which could benefit from a rebound in infrastructure and real estate as mortgage volumes pick up. These businesses have paid dividends for decades, and they've increased those dividends year after year. That's the kind of asset you want before retirement. Not speculative growth stocks, not risky ventures, boring, stable, dividend-growing companies that will pay you reliably for the next 20 or 30 years of your retirement. Historically, dividend aristocrats, companies that have raised dividends for at least 25 years have outperformed the broader market with lower volatility. That's important for 2026 when we might see tempered gains due to economic shifts. I remember when Microsoft started paying dividends back in 2003, it was a milestone showing maturity in the company. And those payments have grown, providing steady income without touching the principal. Here's how it works. Retire with $1 million in dividend-paying stocks yielding 3%. That's $30,000 a year. But if the dividends grow at 7% annually, after 5 years, you're collecting about $42,000. After 10 years, about $59,000. After 20 years, about $116,000. Your income can double, triple, even quadruple over retirement while you never sell a single share. Your capital remains invested and can be passed on to your kids or directed to philanthropic causes. Dividends are income that comes from the profits of great businesses. So asset number one is a diversified portfolio of quality dividend-paying stocks, quality companies with strong brands, competitive advantages, growing earnings, and long histories of increasing dividends. Build it before you retire. Hold 10, 15, 20 different companies across industries and plan to hold them forever. Diversify across sectors to weather any 2026 volatility. Keep emotions in check and stick to fundamentals. Now, the second asset you need before retirement is a low-cost S&P 500 index fund that you never touch. Yes, you need both. The dividend stocks are your income engine. They pay you cash. But the index fund is your inflation protection and long-term growth. Even with dividend growth, you might face high inflation, unexpected expenses, or you might live longer than you planned. You need assets growing in value, assets you can tap if necessary. An S&P 500 index fund gives you broad exposure to America's 500 biggest companies. Over long periods, it has delivered solid returns, historically around 10% annually, beating most active managers. You don't need to manage it. You own it and let it grow. With 2026 forecasts showing U.S. equities outperforming globally, this fund could capture upside from strong corporate earnings and resilient growth. I've always advocated long-term thinking. Index funds capture broad innovation the way Microsoft evolved from software to a cloud giant. Think of it this way. The dividend portfolio is your checking account. You draw income from it. The index fund is your savings account. You don't touch it unless you have to. Retire with 700,000 inches dividend stocks and 300,000 inches an S&P 500 index fund. The dividends pay you to live. The index fund grows in the background. Over 20 years at historical returns, that 300,000 could become about 2 million together. They create a portfolio that's nearly bulletproof. In an uncertain 2026 economy, this balance matters. Keep fees low with options like Vanguard or Fidelity because costs compound against you. The third asset you must buy before retirement is real estate that generates income, not your primary residence. Your house is not an investment, it's an expense. It costs taxes, insurance, maintenance. I'm talking about rental property or real estate that produces monthly cash flow. Rental income tends to be stable, people need places to live, and rents rise with inflation. Real estate also diversifies you. It's not perfectly correlated with stocks. When markets crash, properties can still generate income. I've invested heavily in farmland through Cascade Investment, and while farmland isn't traditional rental, the principle is similar. It generates income through leases or production, and it can be resilient over time. Picture this, 10 years before retirement, you buy a rental property for $300,000, put $60,000 down, finance the rest. It generates $2,000 a month in rent, and after expenses, you net about $300 a month at first. Over time, you're building equity as the mortgage gets paid down, and the property may appreciate. By retirement, the mortgage is paid or nearly paid, and now the property generates maybe $1,000, $500 a month in net income, about $18,000 a year. Own 3 properties like that, and you've got $54,000 a year in rental income. Add dividends and Social Security, and retirement gets comfortable. Not everyone wants to be a landlord, and I get that. You can use REITs, real estate investment trusts, to get exposure without the work. Either way, you need real estate in your retirement portfolio. That's asset number 3, income-producing real estate, or REITs, stable cash flow that rises with inflation. Looking toward 2026, adding diversified real estate exposure can hedge risks. And if you're thinking long-term, consider sustainability and climate resilience in what you own. The 4th asset you need before retirement is Treasury inflation-protected securities, TIPS or I-bonds for shorter-term needs. Regular bonds can be terrible in inflationary environments, but TIPS are designed to protect purchasing power. The principal adjusts with inflation, and you earn interest on the adjusted principal. Why does this matter? Inflation destroys fixed income retirees. If you retire on $50,000 a year and inflation runs at 4% for 10 years, you lose about a third of your purchasing power. TIPS help prevent that by keeping part of your portfolio tied to inflation. I'd suggest maybe 10 to 20% in TIPS, not the majority, but enough to provide stability and peace of mind. Stocks and real estate are your offense, TIPS are your defense. You can buy them through Treasury Direct. This is asset number 4, TIPS or I-bonds, your inflation defense. The 5th and final asset you must buy before retirement is a paid-off house or very low housing costs. Earlier I said your house isn't an investment, and it isn't, but having a paid-off house before retirement is one of the smartest moves you can make, because housing is usually your biggest expense. If you're paying $2,000 a month, that's $24,000 a year. Over 20 years, that's almost $500,000. If you own your home free and clear, your costs drop to taxes, insurance, and maintenance, maybe $6,000 to $8,000 a year instead of $24,000. That frees up about $16,000 annually and lowers how much income you need. It also gives you flexibility if markets have a bad year or you face unexpected expenses. If you're approaching retirement with a mortgage, paying it off should be a top priority. Yes, sometimes the math says invest instead of paying off a low-interest mortgage, but retirement isn't just math. It's peace of mind, security. If you're younger, buy less house than you can afford, consider a 15-year mortgage, and pay it down aggressively. If you're older and still have a large mortgage, either commit to paying it off before retirement or plan to downsize to eliminate it. What you can't do is retire with a big mortgage payment and hope it works out. So that's asset number 5, a paid-off house or very low housing costs. Now let me recap the 5 assets. 1, a diversified portfolio of quality dividend-paying stocks, your income engine. 2, a low-cost S&P 500 index fund. You never touch your long-term growth and inflation protection. 3, income-producing real estate or REITs, stable inflation-linked cash flow. 4, TIPS or I-bonds, your inflation defense. 5, a paid-off house or low housing costs, which makes retirement vastly more affordable. People always ask, what percentage should I have in each? For someone retiring in the next 5 to 10 years, as a general guideline, not personal financial advice, 50 to 60% in dividend-paying stocks, 20 to 25% in an S&P 500 index fund, 10 to 15% in real estate or REITs, 5 to 10% in TIPS, and then your paid-off house outside the portfolio. These can shift based on your risk tolerance, but the key is having all 5, because each protects you from different risks. Market crashes, real estate and TIPS can help stabilize. Inflation, dividend growth, and real estate can adjust. Longevity, the index fund keeps compounding. High expenses, low housing costs, reduce the pressure. Together, these assets create confidence, not hope. Now, common mistakes. First, putting too much in bonds. Bonds don't grow and can fail against inflation. Second, not owning enough income producing assets, so you retire with growth stocks and have to sell shares to live. Third, retiring with a mortgage, which raises the income you need and increases risk. Fourth, not diversifying, concentrating in one asset class. Fifth, waiting too long to start. You can't build this in a few years. It takes decades. Compounding needs time. Real estate needs time to pay down and appreciate. Index funds need time to grow. Let me give you a roadmap by age. In your 30 seconds, focus on building the index fund and starting the dividend portfolio, and invest in your education so you understand what you're buying. In your 40 seconds, add real estate, start buying tips, and accelerate mortgage payments. In your 50 seconds, aggressively build all 5 assets, max out retirement contributions like a 401, buy income assets, and reduce debt. In your 60 seconds, if you haven't done this, you may need to work longer or lower expectations. There's no magic solution when time is gone. So wherever you are, start today, buy your first dividend stock, invest in an index fund, research rental property or REITs, buy some tips, make an extra mortgage payment. These assets don't build themselves, and retirement doesn't wait. I've seen so many people reach retirement age without preparation. They thought they'd figure it out later, thought Social Security would be enough, and now they're still working or struggling. It doesn't have to be that way. Build these 5 assets consistently and you can retire securely, confidently, with peace of mind. So here's my challenge. After you finish this, take action. Pick one of these 5 assets and do something about it today. One step, then next week another step, next month another. Build slowly and consistently. I'm 70 years old and I've seen good retirements and bad ones. The good retirements belong to people who built the right assets. Don't let yours be the bad kind. Build these 5 assets. Start now. Stay consistent and retire with confidence instead of fear. Thank you for watching. Now go build those assets. Your future retired self is counting on you.